Hello everyone, I'm Yali Jiang, and today I want to talk to you about something that most financial commentators are underweighting, the silver market. Right now, as gold trades above $5,000 an ounce, silver is sitting at $81. That ratio tells a story, a big one. And if you understand what that gap means historically and what forces are now converging to close it, you'll understand why silver may be one of the most important trades of the next several years. What you're about to hear isn't speculation. It's a structural case built on price behavior, industrial demand, monetary history, and market mechanics. Pay attention. Before we go further, subscribe right now because what you're about to hear explains a shift most investors still haven't noticed. Let me walk you through the numbers. As of today, February 20th, 2026, gold is priced at $5,040 per ounce. Silver is at $81 per ounce. That gives us a gold to silver ratio of approximately 62 to 1. Now, I want you to sit with that number for a moment because it carries enormous analytical weight. Throughout most of monetary history, that ratio traded between 15 and 20 to 1. That's not an arbitrary figure. It roughly reflected the natural abundance of silver relative to gold in the Earth's crust, and it reflected the monetary parity that governments and markets assigned to both metals for centuries. Even in the modern era, the ratio has averaged around 60 to 1 over the last 4 decades. So at 62, we're near that modern average. But here's where it becomes important. We're not in a normal modern era right now. Gold has risen 71% in a single year, and silver, despite its dual nature as both a monetary metal and an industrial commodity, has not kept pace. That divergence is a signal. Look closely at this trend. When gold makes a sustained structural move higher, silver historically follows, but with a lag. And when silver catches up, it tends to overshoot. This is documented behavior across multiple commodity cycles. In the late 1970s, gold led the precious metals rally, and silver eventually moved from around $5 an ounce to nearly $50 in January of 1980, massively outperforming gold on a percentage basis in the final stage of that cycle. In 2010 and 2011, gold climbed steadily toward $1,900, while silver initially lagged, then surged from around $18 to nearly $50 in a matter of months. The pattern has appeared before. Gold leads, silver consolidates. Then silver accelerates. The question isn't whether this dynamic exists. It does. The question is what triggers the acceleration. Now notice what changed over the past decade in silver's fundamental structure. Silver is no longer purely a monetary metal. It never was, entirely. But the industrial side of the equation has grown dramatically. Photovoltaic solar cells, the panels that capture sunlight and convert it to electricity, require silver. A lot of it. Silver is the best electrical conductor of any element on the periodic table, and solar panel manufacturers need it in quantities that are scaling rapidly alongside global green energy buildout. The International Energy Agency has documented the expansion of solar capacity year after year, and silver demand from that sector alone has been climbing steadily into the hundreds of millions of ounces annually. Add to that electric vehicles, which use silver in their electrical systems, charging infrastructure, and battery management. Add 5G telecommunications equipment, medical devices, water purification, and semiconductor fabrication. The industrial demand profile for silver is not shrinking. It is structurally expanding. Let me walk you through the supply side, because this is where the story gets more complicated. Silver is not primarily mined as a standalone product. Roughly 70% of annual silver production comes as a byproduct of mining for copper, zinc, lead, and gold. That means silver supply is not directly responsive to silver's price signal in the way that primary commodity supply would be. If copper demand falls and copper mines reduce output, silver supply falls with it, regardless of what silver itself is doing in the market. This creates an inelastic supply dynamic that most retail investors underappreciate. You cannot simply build more silver mines quickly in response to rising prices. The permitting process, the capital expenditure requirements, the timeline from discovery to production, these are measured in years and decades, not months. So when demand rises and price rises, supply cannot respond quickly. That mismatch is inflationary for the metal's price. Now look closely at what the dollar has been doing. Gold's 71% move over the past year is not happening in a vacuum. It is happening in an environment where confidence in fiat currency, particularly the US dollar, is under sustained pressure. Persistent inflation over the last several years has eroded purchasing power in ways that are psychologically significant. When people feel the price of everyday goods rising, they look for stores of value. Gold has been the traditional beneficiary of that psychology. But here's where it becomes important. Silver shares that monetary psychology while also benefiting from real industrial demand. That dual demand structure is what makes the current moment so analytically interesting. You have a metal that functions both as a monetary hedge and as an industrial input for the fastest growing energy technology of the modern era. Let's talk about ETF flows because they give us a window into institutional and retail positioning. Silver ETF holdings have experienced meaningful volatility over recent years, with large outflows during periods of dollar strength and rising real interest rates. When real yields were strongly positive, the opportunity cost of holding non-yielding assets like silver and gold was high, and money left. But look at what's happening now. Gold is at $5,000 despite the interest rate environment. That tells you that the inflation hedge narrative and the currency confidence narrative are strong enough to override the traditional rate-driven headwinds. If and when rate expectations shift, if markets begin pricing in rate cuts or begin questioning the sustainability of current policy, silver ETF flows could reverse sharply to the upside, compressing the ratio with significant velocity. The dollar correlation is also worth examining directly. Silver historically has an inverse relationship with the dollar index. A weakening dollar tends to benefit silver on two fronts. It makes dollar-denominated commodities cheaper for international buyers, stimulating demand, and it reinforces the monetary hedge narrative that drives speculative and investment flows into precious metals. We have seen gold demonstrate this mechanism powerfully. Silver's response has been more muted, which in analytical terms suggests pent-up potential rather than structural weakness. This pattern has appeared before, and the timing of silver's relative underperformance in a gold bull market is consistent with prior cycles. Silver often underperforms in the early and middle stages of precious metals rallies because industrial demand is more sensitive to economic growth concerns. And when recession fears circulate, the industrial component weighs on price. But when the monetary narrative dominates and when industrial demand proves resilient, silver transitions from laggard to leader. That transition tends to be sudden and significant. What does all of this suggest about inflation? It suggests that inflation is not a short-term episode in the minds of investors and institutions that are moving into gold at $5,000 prices. Nobody pays $5,000 an ounce for gold if they believe inflation is resolved and purchasing power is stable. The price of gold is an opinion poll about the monetary system, and right now the poll is registering serious doubt. Silver participates in that doubt, but adds to it the concrete physical demand from industries that are not going away. Solar energy is not a fad. Electric vehicles are not a temporary trend. The electrification of the global economy is a structural transformation, and silver sits at the center of that transformation's supply chain. What does this suggest about currency confidence? The 71% move in gold over a single year is an extraordinary statement. It says that a meaningful segment of the investment world, institutions, central banks, individual investors, has decided to pay almost any price to hold something outside the fiat currency system. That kind of move does not reverse quickly. It reflects a shift in the fundamental trust relationship between investors and the currencies in which they operate. Silver, as a secondary monetary metal with deep historical roots and expanding industrial relevance, benefits from exactly this shift. The case for silver is not that it replaces gold. The case is that it participates in the same underlying dynamic while also being driven by forces that are entirely independent of monetary psychology. What does this suggest about investment psychology? It suggests that the crowd has not yet arrived. Gold at $5,000 is front-page news. Silver at $81 is not. When retail investors begin connecting the dots, when they see gold's move and begin asking what other assets benefit from the same forces, silver tends to absorb a wave of attention and capital. That wave has historically been amplified by silver's smaller market size relative to gold, which means that equivalent dollar flows move silver prices by larger percentages. The market is not deep. Position sizes that are manageable in gold can be significant in silver. This amplification effect is well documented and is part of what generates silver's historically larger percentage swings. Let me bring this together. The silver market today presents a convergence of conditions that have, historically, preceded significant price moves. Gold is already reflecting a serious structural shift in monetary confidence. Industrial demand for silver is growing from multiple directions simultaneously. Supply is constrained by the byproduct mining structure. ETF flows remain below peak levels, suggesting room for institutional reentry. The gold-silver ratio, while near its modern average, is historically elevated relative to the monetary realities of a sustained gold bull market. And investor psychology has not yet rotated to silver in the way that typically follows a gold leadership phase. None of this means silver moves in a straight line. Volatility is inherent in this asset. Short-term corrections can be sharp and discouraging. The industrial component can create downside sensitivity to negative economic data in ways that pure monetary metals do not experience. These are real risks, and they deserve honest acknowledgement. But the long-term structural case is difficult to dismiss. Silver is playing a role in the energy transition that is mandatory, not optional. The supply structure is not capable of rapid response to higher prices. And the monetary forces that have driven gold to $5,000 have not resolved. If anything, the conditions that generate demand for precious metals, inflation, currency doubt, geopolitical uncertainty, show little sign of abating. Investors who are watching gold's extraordinary move and asking where the next opportunity lies within the precious metals complex should be studying silver seriously, not as a replacement for diversification and prudent risk management, but as an asset whose current pricing may not yet reflect the full weight of the structural forces building beneath it. The ratio will not stay at 62 forever. It never has. And when it moves, silver's percentage gains relative to gold have historically been substantial. That is the silver story as it stands today. Watch the ratio. Watch industrial demand data. Watch ETF flows. Watch the dollar. These are the instruments in this orchestra, and right now they're beginning to play in the same direction. Thanks for watching. Subscribe, share this, and stay alert. Because what's happening in the silver market right now matters more than most people realize.